Hi students. Well, in this final video on so many videos on EPS, we're going to put it all together with a big comprehensive example. And one suggestion I may have for you is that as we do this, why don't you try and do it on your own? And what I mean by that is we'll get the information and you can pause the video and, for example, try and figure out basic EPS. And then go through that part of the video. And then as we go to do the Treasury Stock method for the options, you could just pause the video and do that on your own. Remember, there's no substitute for doing your own accounting. Videos can be helpful, but in the end, you still have to go and do all this and practice it, right? So on the screen here, I have our final example, and this has lots in it, so it's a good example. And let's just go over this briefly so we know where we are. We have net income here, just informing you tax rate is 30%. We had 1 million shares outstanding all year. Now, we obviously have a complex capital structure, and starting with cumulative convertible preferred shares. Now these convert into 80,000 common, and just remember when it says 10%, like instead of saying like $3 or something, it says 10%. So you're going to take this 1.6 million times 10%. Then we have convertible bonds, 8% bonds converting to 75,000 shares. And there's your face amount of the bonds. And 90,000 stock options, 1 for 1, so 90,000 shares, exercise price 25, and the average price for the year was $30. Okay, so this is all the information that we need to calculate both basic and fully diluted EPS. So anyway, just a suggestion, you may want to pause the video and calculate basic EPS. And I'm going to do that now too. I would like to remind you that when you have net income 3.5 million and you have preferred shares, this is not net income available to common shareholders. We need to first deduct the preferred share dividend. So let's do that here on this next slide. So, okay. Here is the 3.5 million. Remember, we had 10% preferred. 10% is 160,000. So income available to common shareholders, 3.34 million divided by 1 million shares is 334. Now, when you have a number of potentially dilutive securities, you need to calculate each one individually. And that's what we're going to do next. We're going to calculate the individual number for all of these, and then we're going to do them in the order of worst to best. And that's because as you get bigger numbers in these potentially dilutive securities, and I mean bigger in terms of a higher EPS figure, there's a possibility that what initially looked dilutive is actually bigger than your ongoing number that you're working out and turns into anti-dilutive, and then you would not include it. Now that's not the case in this example, but we do need to do them in order worst first. And options are always worst because there's no numerator. Therefore, it doesn't matter where you were to put them, but they are always dilutive. So we're going to do our options first. Now we have our basic EPS. Let's look at the options, and recall we're going to use the Treasury Stock method. So we have 90,000 of them, and the exercise price is $25. So we just multiply that out. We have 2.25 million in money. Remember, this is not net income. So we say, well, what would we do with 2.25 million? We would buy back our own shares at the average price for the year. So here are the 90,000 shares that would have been issued if the options had been exercised. Here's our 2.25 million divided by the average price a year. We would have for the year, we would have bought back 75,000 shares, leaving us with a net increase of 15,000. There is no numerator, it's dilutive. So that's kind of what we would end up with, right? This is the 15,000 added in. We would be at 329. Okay, let's look at the bonds and look at the preferred shares. So recall that there is an income tax effect with bonds, but not with preferred shares. So the bond face value times the interest rate times 1 minus the tax rate means our income would be higher by 140,000 if these bonds had been converted at the beginning of the year. And it said in the data that they were convertible to 75,000 shares. So we're going to divide that out. 140 divided by 75 gives us $1.87. And of course, our basic EPS was far higher, so these are dilutive. So we have to keep that in mind, keep these two figures in mind for our table at the end. Now let's look at the preferred shares. For the preferred shares, these were 10% on 10% on 1.6 million. So our numerator is actually the 160,000 dividend. Now, we're not saying our income would go up, because it doesn't, but the income available to common shareholders, which is the numerator, would go up because you would not pay that 160 dividend. Okay, so we're definitely having a numerator increase of 160. I mean, this isn't really correct. In reality, we're just saying income available to common shareholders would be the full net income for the year. And the shares effect, well, they were convertible into 80,000 shares. And finally, we don't need our calculator, right? 160 divided by 80 is $2. So these are dilutive. So the only thing we need to do now that we've figured out all three of these is we need to put them in order worst first. And of course, that was the options, then the $1.87 for the bonds, and then the $2 for the preferred share. So we're going to finish this with the table, and we're going to put them into the table in that order. And, you know, I think this topic is interesting, and you're definitely going to see it on a final exam. This is a common exam topic. Now, I think what you'll note is that if you know how to do this, it's quick. Like this is going to be maybe a 10 or 12 minute video, and you could do this yourself in 10 or 12 minutes. So the knowledge is the key, right? If you know how to do this and you see it on an exam, you can do it really quickly. And of course, more importantly, when you go to work, you'll know how to do it. So let's look at the final slide here where we put all of this together. So the basic EPS, as you recall, we already calculated that, and we had this much income divided by the million shares was 334. Now, options come first. No income effect, we would end up with 15,000 more shares. So here's the new calculation, right? I've added these two, and our new EPS, our first part of diluted EPS, would be 329. Now the bonds were worse than preferred shares, and the numerator for the bonds was 140. The number of shares was 75,000. So again, we just add these, and here's what we have when we add those together. So here we have 319. And as you recall, the preferred shares had an individual EPS of $2. So they are still dilutive, and we'll still include them. Now, I mean, I guess you can look at this and see where we're going, but just a note, here's a what if, right? Let's just say that the preferred shares had an individual EPS, I'm just going to write it here, of 322. Okay, so let's just say they had come out to 322. Now, when you first compare that to 334, you'd say, oh, look, they're dilutive. And then you would do the options. And then you would do the bonds. But we would be at 319. So if the individual number for preferred shares was 322, and we were sitting at 319, then they would in fact be anti-dilutive when we finally calculate everything, and we would just not include them, and we would be finished at 319. So that's not our actual example. I'm going to take that away, and they were $2. So here's the preferred shares numerator and denominator. Earnings available to common shareholders go up 160,000, and we would have 80,000 more shares. So this is our final numerator and denominator, and when we divide these out, we can see that it's $3.11. So not really that bad a topic. If you do a little practice with this, you'll get it right.